My clients are people who hate taxes. Many are high net worth individuals who own businesses, they're high income or wage earners, and many are self employed and they hate taxes. So, today I want to talk to you about how you can make your retirement as tax free as possible using a LIRP. I'm John Davis. I'm a financial and I'm an estate planner and I'm a certified financial fiduciary. I'm with a company called American United Wealth Planning. And today we're sharing our knowledge and ideas to make life richer for you and your loved ones. So, what is a LIRP? Well, a LIRP is a life insurance retirement plan. It's designed to reduce or eliminate taxes and create a tax-free retirement. It uses a specially designed permanent life insurance policy that's actually approved by the IRS. So you might be asking, well, why do I need a LIRP? Well, I don't know if you need one or if you don't. It really depends on the way you feel taxes are going, the way you see taxes going. Do you see them going up in the future or going down? Now, if you look at this chart and you look at the red line moving from left to right, you'll see that that's our tax income. And you'll see that taxes back in the 1940s and 50s were up around 90%. And as you follow that line to the right, you'll see that the taxes are now down to around 37%. If you look at the dark blue part of the chart, that's our national debt, and you can see it's ever climbing. In fact, the chart shows 28.2 trillion, but it might be actually much higher than that, but we'll just go by what the chart says. So here's the problem. The problem is that the national debt keeps climbing and the income coming into the country keeps dropping. Problem here is this is just like at home. If your income doesn't meet your obligations, you're going to go broke. And so in order for our country to make good on its debts, it has no choice but to increase its income, which means it's going to increase taxes. Let me ask you a question. Are you prepared for this? Many are not. Here's the thing. You need to protect your future retirement, and you need a savings vehicle that does that and does it two different ways. The first way is you need to be able to safely save as much money as you want while consistently growing your money without incurring stock market losses along the way. The second thing you need is you need easy access to your money without the age 59 and a half traditional IRA or 401k restrictions and penalties. And finally, you need the ability to access your money without half of it going in the form of income taxes to our government. Well, the good news is there's a savings vehicle that's been around for over 100 years, and it's known as a permanent life insurance policy. With it, you can withdraw your money out 100% tax-free, and you can pass it on to your heirs 100% tax-free after you're done using it. Now, in order to do this, the policy has to be constructed in a way that it follows the IRS tax code, which are sections 7702 and 72E. See, when it comes to life insurance, there are only two types of life insurance policies, and they both share the same form characteristics. Now, they call them different names, but those are for marketing purposes. Really, truly, there's only two kinds. The first kind is called a term insurance policy, and you're probably familiar with this, and I compare term insurance to renting a home. The second type of life insurance policy is called a permanent life insurance policy, and this is very much like buying a home. So let's look at those four characteristics. So the first characteristic of term insurance is that it's a lower cost initially. Kind of like renting a property. You come up with the first month's rent and you come up with a deposit. It's easy to get into, it's low cost. The second characteristic is that it's designed so that the cost goes up. Just like a lease, at the end of your lease, your landlord comes to you and says, hey, your lease is up. If you want to stay here, we're going to have to increase your rent payments to cover the new year. Well, term insurance is kind of the same way. Term insurance is usually issued in 5-year, 10-year, or 20-year increments. Sometimes you're lucky and you could get 30-year increments, but you have to be pretty young to be able to get that. The third characteristic is that it has no cash value. it doesn't have any equity like you get in a home. So what happens is that you pay payments into this policy, and at the end of the policy, there's nothing to show. Many people can compare this to rent, where you pay your rental payments, but you have nothing to show. The rent is kept by the landlord. In this case, the premium is kept by the insurance company. And the fourth characteristic is that the coverage eventually ends. Even if you're in good health, it's going to end at the end of the term. And in fact, in many cases, once a person starts hitting, I would say in that 50 to 60-year-old age range, what happens is the cost of term insurance becomes prohibitive. And in many cases, they're not able to get insurance because they simply can't afford it. Now let's take a look at permanent insurance. The first characteristic of permanent insurance is that it has higher cost initially. Just like buying a home, when you buy a home, you have to come up with a down payment. You may have to come up with money for taxes and for other purposes. The second characteristic is that if it's designed right, it'll stay level. So let's compare this to a 30-year fixed mortgage. If you get a 30-year fixed mortgage, the payments stay level. Well, you could design a permanent life insurance policy so that the payments stay level. The third characteristic is that it has the ability to build cash value. Just like the equity in your home, you can build cash value in your permanent life insurance. And of course, the fourth characteristic is that it's designed to provide coverage for life. So when you get a permanent life insurance policy, just like the name implies, it's permanent. It's something that you're going to keep all your years. Now, this is often where the discussion about life insurance just plain stops. You see, if you mention life insurance, a lot of people will automatically become negative. So you might be asking, well, why is that? Well, it's because they don't know any better. They only know about life insurance death benefits, and they figure they'll be dead. The only people that will ever benefit from their paying into the policy will be their family members. So they become somewhat negative. Okay, they also, because of this, they also lose out on living benefits, that you could get in a properly designed permanent policy. So often life insurance winds up being looked at or viewed as another bill that people have to pay each month. So what they do is they go out and they look for the lowest monthly premium, and they end up buying term insurance. Okay. So what I want to show you today in the next slides is a lot more interesting and a lot more exciting. In fact, it could change your financial life in the future. So pay close attention. Now, besides a death benefit, which you get with all insurance policies to protect your loved ones, a permanent life insurance policy gives you two really important benefits. The first is, well, let's say you need money for whatever reason. It can give you tax-free access to cash without restrictions and without penalties. And you can get that cash whenever you need it, whenever you want it. The second is, let's say that future tax rates, like the chart shows, shoot through the roof, okay? If you follow the tax rules, it can give you a tax-free retirement income when you retire. Now, to understand the power of these benefits, we need to look at how your money gets taxed when you're declaring income. So that's what we're going to do in this chart. So your money basically falls into one of two taxing buckets. The question is, which bucket would you rather have your money taxed in? The first is the capital gains income tax bucket. This is income that comes from the sale of stocks. It comes from the sale of mutual funds, the sale of a business, or the sale of an investment piece of real estate. Okay? Anything that you can own for 12 months or more, you end up paying capital gains tax rates on. Now, the tax rates are running from 15 to 20%, but they're expected to go higher in the future. Okay. Now, the second bucket, and this is the one that most people are familiar with, is the ordinary income tax bucket. Now, currently, the highest rate is 37%. So my question again to you is, are taxes going to go up higher in the future, or are they going to stay lower? When I poll most people, they just say higher, and I agree with them. So what goes into this bucket? which falls in this category is what I call the alphabet soup of retirement plans. So what we're talking about is we're talking about IRAs, SEP IRAs, and simple IRAs. We're also talking about 401ks and 403bs. Anything that falls under the heading called a tax qualified retirement plan gets taxed at ordinary tax rates. Now, the key understanding to this is that the money you put into a tax qualified plan, like a 401k or a traditional IRA, is not being taxed as it's going into the plan. Instead, it gets taxed when you take it out. You're forced actually to pay taxes on all of it. Future tax rates might be sky high. We have no idea what they're going to be. So that's where the real problem is. So having said that, what a lot of people will ask me is, where can I put my money and not get it taxed when I take it out? Well, there's only three places that I could think of. Okay, the first is municipal bonds. That's one area where you can put it in and not get tax taken out. The other possibility is Roth IRAs. And of course, the third possibility is to use a permanent life insurance policy. So here's the thing, when it comes to municipal bonds, I don't count them. You see, historically, they have poor returns. There's also no asset diversification with a municipal bond. And they're also invested in risky municipalities. Often these municipalities have junk bond ratings. So there's a lot of risk to putting money in municipal bonds. The second area is Roth IRAs, and I don't really count them either. And the reason for that is simply because you just can't put that much money into them. I mean, your maximum contribution is $6,000, and you can add in another $1,000 if you're 50 or older. And also, if you're a high wage earner or a professional or business owner, let's say you're a single individual and your income is $144,000 a year or more. Well, guess what? You can't contribute to a Roth. If you're a married couple and your income jointly is $204,000 or greater, again, you can't contribute. Now, fortunately, the last category or area where you can put it in and get it out tax-free is called called a permanent life insurance policy. And of course, this is really a good option. We're going to talk more about that in the future. All right, so there are two ways that most people save for retirement. What most people do is they put their money in a tax-deferred 401k, 403b, an IRA, or a SEP. Now, if you're tax savvy, you'll put your money into a tax-free account. So let's look at the differences. So I want to test you here. Is the money that you put into a tax-deferred IRA, 403 IRA, or a SEP, is that taxed when it goes in, or is it taxed when you take it out? Now, if you said, no, it's not taxed when it goes in, it's taxed when it goes out, you'd be correct. You see, when you go to take it out, you'll be taxed on whatever you put in plus whatever you take out, whatever you made on the account. Now, on the flip side, if you look at tax-free accounts, the money you put in is taxed at the point that you put it in. But the beautiful thing about tax-free accounts is that when you take your money out, when you take it out, there are no taxes due. And so you have to ask yourself, which would you rather pay taxes on? Would you rather pay taxes on the seed money that you're putting in or the harvest money? In other words, pay taxes on all of it, what you put in and what you're taking out. Well, when I ask most people, they'll say, I don't want to pay taxes at all. So let's look at a couple examples of how you can use a permanent life insurance policy to your advantage. Okay, so let's say that you're an individual who wants access to your cash, but you also want to create wealth. Well, in this example, you're borrowing from your policy instead of using a bank. No bank. In fact, you don't have to borrow from a bank. Instead, you can use the cash built up in your policy, and you can actually borrow from yourself. You're borrowing from your policy. And the great thing is that you can choose to either pay yourself back or choose to not pay it back. Here's how it works. Pay close attention. Now, here's the thing. If you have to stop this video and rewind it a little bit and replay it again, go ahead and do that, because I want you to get the essence of what we're talking about here. So let's say you need a $25,000 loan. Maybe you need that for your child's tuition, or maybe you're remodeling your house. I don't know, you need it for some purpose. The insurance company will give you a $25,000 tax-free loan. You don't pay taxes on loan proceeds, so it'll be tax-free. They'll secure their loan with a $25,000 lien against the accumulated cash value in your policy. So you're not taking the cash out of your account. Pay close attention here. You're just using your account as a security deposit, okay? The insurance company might charge you, as an example, a 6% fixed rate for that loan. But at the same time, they're going to credit your cash account with 6%. So what's happening here are the two interest rates are actually washing themselves out. So the loan is actually costing you nothing. So now you can choose to pay back the loan, or you can choose to not pay it back. If you don't pay it back, that's not a problem. The money will be actually taken out of the death benefit part of your life insurance policy to pay off the loan balance. So you don't have to worry about paying it back. But let's say that you decide to pay back the loan with interest and put the money back into your policy. So in this example, you're using the cash value in the policy to secure a loan from the insurance company. That's number one. And number two, at the same time, you're going to actually create wealth for yourself. Here's how it works. Remember, the $25,000 loan from the insurance company is costing you nothing. These are called wash loans or zero cost loans. So step one to do this is you call your local bank and you ask them what interest rate they would charge you on a $25,000 personal loan and how long they would give you to pay it back. So they might tell you something like 10%, and they'll give you 4 years to pay back the money, and they're going to charge you about $634 a month. You really don't care what the terms are. You just want to find out what the terms are. And the reason for that is instead of borrowing from the bank, you're borrowing the cash value from your policy using a wash loan from the insurance company. So step two is you call your insurance company and you take the $25,000 wash loan. You then pay back the insurance company the loan, the wash loan, using the same exact terms that you got at the bank. The 10% interest you would have given to the bank gets paid back into your cash account. The insurance company's loan is paid off. You're 10% richer instead of your bank. You just borrowed tax-free with a wash loan without any restrictions, and you created wealth for yourself. The money that you paid into your account that would have otherwise gone to your bank is again paid back to yourself into your account. You became your own banker. Okay? So, pretty cool, right? Well, it gets even more exciting. So let's celebrate by saying happy retirement. Let's look at the ultimate example. This time you're using your life insurance policy to create a future of tax-free retirement income. Okay. So your goal is to grow your cash values in your policy into a retirement nest egg over time to create a tax-free retirement income after you retire in the future. All right, so you've been funding your policy, and over time, your indexed cash account value has enjoyed compounded growth at anywhere from 5 to 12% per year with earnings caps, but with zero stock market risk or losses. So you're earning money in your cash account and it's compounding. All right, so now you're age 65. Congratulations. And you're ready to retire. So now you have $1 million in your cash accounts, and you have two options to take it out. The first option is you can call your insurance company and you can have them send you a check for $1 million. The problem here is that you'll get taxed on the amount that you earned above the amount you paid in. So that's one option, but I don't think it's the best option. The second option, which I believe is the best option, is you can ask the insurance company to figure out how much they can pay you under the IRS rules to pay you a lifetime of tax-free income. Okay, they do so. And now you're getting $40,000 per year for your entire life, and all of it completely tax-free. So now, of course, this is just an example. Your income is will be based on how much you put into a policy, the terms of the policy, how long you have it, and of course the policy terms and earnings. All right, but in this example, we followed the IRS tax rules and created a tax-free income for life. Isn't that great? This is a fantastic tool if it's used right. So let's take a look at the type of permanent life insurance policy that allows you to get these kinds of benefits. So here you are contributing money into an indexed universal life insurance policy. This is a permanent life insurance policy, okay? Like all financial products, a small fee is taken out by the company. However, the bulk of the premium that you paid in goes into the cash value of your policy, and that's what you use to build your cash value over life. Now, as the cash value earns and compounds interest and grows in the policy, periodically the life insurance company will withdraw the amount they need to cover the life insurance death benefit part of your policy. So you have to cover the cost of the life insurance policy. All right, so this small red box represents the minimum amount the insurance company says you have to buy the policy and to make the policy work and follow the IRS rules. Now, this much bigger box represents the maximum amount that the IRS allows you to put into this type of policy and get out on a tax-free basis. So you want to save as much as you can into this type of policy. Now, usually usually in my experience, when the IRS limits what you can put into a policy, it's into anything really. It's usually something that's really very good. Okay, so now all you have to do is to decide how much you want to put in between these two boxes, the minimum amount and the maximum that you could save. Now, before you could make that decision or answer that question on how much to put in, you'll probably want to know what the minimum and the maximum contribution amounts are for each of the boxes, wouldn't you? That makes sense, doesn't it? All right, well, this is where you need to contact me so that I can figure that out for you, okay? Now, using life insurance as a savings tool is not a new concept. You know, it's the key that can be used to unlock future success. In fact, Walt Disney did that himself. He borrowed from his life insurance back in 1953 to help fund Disneyland, this first theme park. The reason he did that is because no banker would lend him the money that he needed, okay? John McCain, United States Senator and former presidential candidate, he secured initial financing for his campaign, and he used a life insurance policy to do that. It's a proven financial approach. In 2002, Doris Christopher sold her kitchen tool company, the Pampered Chef, to Warren Buffett for a reported $900 million. Now, 7 years earlier, she launched the company with a life insurance policy loan. So you see, this is not something that's new. It's been around for a long time. So I'm John Davis. Again, I'd love to help you. I'd love to discuss this with you, and I'd love to compute some numbers for you. If you have any questions, give me a call. There's my contact information on the screen. Also, I want you to know that we're totally COVID safe. If you want to meet in person, we can do that, but we can also do all of our business, including completing forms and applications and signing things. All that can be done across the internet. So you can do that all from the comfort of your home, completely COVID safe, and you can just be comfortable. We could go through it together. It's not a big deal. That's, I guess, if you could say anything that came out of COVID that was good, it was the ability to be able to be COVID safe. So that's it for now. If you have any questions, pick up the phone or send me an email. I'll be glad to help you. Have a good day. I look forward to talking to you in the future.